keeping consumer price inflation from falling more sharply. Globally, monetary policy is likely to remain focused on ensuring inflation continues to retreat, implying policy rates will stay higher. We expect markets in major financial centers to remain volatile. Taking these and other factors into account, the SABC's forecast for global growth in 2023 is revised marginally higher to 2.5% and remains unchanged at 2.7% in 2024. While South Africa's economic conditions appear to have improved, the longer-term outlook mirrors the uncertainty of the global environment. Prices for commodity exports continue to weaken. In addition, energy supply pressures remain, and stronger El Niño conditions threaten the agricultural outlook. For 2023, the bank's forecast for South Africa's GDP growth is slightly higher than in May at 0.4%. Energy and logistic constraints remain binding on the growth outlook, limiting economic activity and increasing costs. From a demand perspective, spending by firms, households, public corporations, and general government remains positive in real terms. Disposable income of households continues to grow, albeit slowly. Investment by the private sector and the public sector is revised up, and the terms of trade have remained more beneficial than previously forecast. Debt service costs of households have increased to 8.4% of disposable income and now sit at around the average for the past decade. Although credit growth to households and corporates has slowed in recent months, it has increased in real terms compared to last year. Our GDP growth forecast for 2024 and 2025 is unchanged from the previous meeting at 1% and 1.1% respectively. While households and firms exhibit resilience, economic growth has been volatile for some time and highly sensitive to new shocks. An improvement in logistics and a sustained reduction in load shedding or greater energy supply from alternative sources would significantly increase growth. At present, we assess the risks to the medium-term domestic growth outlook to be balanced. Turning to inflation prospects, our current growth forecast leaves the output gap around zero over the next 3 years, implying little positive or negative pressure on inflation from GDP growth. South Africa's external financing needs are expected to rise due to expansion in the current account deficit. Despite somewhat lower oil prices, falling export commodity prices are forecast to result in a current account deficit of 1.9% of GDP this year, 2.9% and 3.3% of GDP in 2024 and 2025, respectively. Sharply lower tax revenue, higher employee compensation, and ongoing financing needs of state-owned enterprises are likely to keep the long-term cost of borrowing elevated. Despite the expected moderation of inflation over the forecast period, long-term bond yields currently trade at about 11.6%. The rand has generally weakened over the past year, depreciating by about 5% year to date against the US dollar and showing high volatility in response to risk on and risk off episodes. The implied starting point for the rand forecast is 18 rands 52 cents to the US dollar compared with 18 rand 73 at the time of the previous meeting. The trajectory for South Africa's headline inflation has been shaped primarily by fuel, electricity, and food price inflation. Compared to the previous meeting, fuel price inflation is lower at negative 3.1% in 2023. The electricity price forecast is unchanged at 11.6% this year, 13.6% in 2024, and 10.9% in 2025, I'm sorry. Our food price inflation forecast for 2023 remains high, but is revised lower in this meeting to 10.3% and up slightly to 5.2% in 2024. Better monthly outcomes have led to a downward revision in our forecast for core inflation to 5.2% in 2023, 4.9% and 4.5% in 2024 and 2025, respectively. Services price inflation in 2023 is expected to come in at 4.8%. Core goods inflation, while still elevated, is also revised slightly lower for this year at 6.2%. Growth is in average salaries and unit labor costs is lower in 2023 and 2024 and slightly higher in 2025. Core goods and food inflation, with core goods and food inflation lower in the near term, headline inflation for 2023 is revised down to 6%. The headline inflation forecast for 2024 also decreases to 5% before stabilizing at 4.5% in 2025. Risks to the inflation outlook are assessed to the upside. Headline inflation at a global level continues to moderate, but food price inflation remains high and oil markets remain tight. Despite recent easing in some food price components, domestic food price inflation is still elevated at 11% in June, and the risk of drier weather conditions in coming months has increased. In the absence of sustained and consistent increases in energy supply, electricity prices continue to present clear inflation risks. Load shedding and logistics constraints may also have broader effects in the cost of doing business and the cost of living. Given uncertain fuel and food price inflation, considerable risk still attaches to the forecast for average salaries. Sticky inflation in major economies suggests that average interest rates in these economies will remain high. As a result, tighter global financial conditions are likely to persist, raising the risk profile of economies needing foreign capital. Higher inflation outcomes have generally resulted in elevated inflation expectations across businesses and households, while market-based expectations have eased recently. The Bureau for Economic Research survey released in July shows average inflation expectations of 6.5% for 2023. Inflation expectations for inflation in 2023 based on market surveys are currently 5.9%, and near-term break-even rates have decreased to around 4.5%. Longer-term expectations remain elevated. Headline inflation returned to the upper end of the inflation target range in June and is forecast to sustainably revert to the midpoint of the target range by the third quarter of 2025. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. Against this backdrop, the Monetary Policy Committee decided to keep the repurchase rate at the current level of 8.25%. 3 members of the committee preferred to keep rates on hold, and 2 preferred an increase of 25 basis points. At the current repurchase rate level, policy is restrictive, consistent with still high inflation expectations and the outlook. Serious upside risks to the inflation outlook remain. In light of these risks, the committee remains vigilant, and decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The policy stance aims to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. Guiding inflation back towards the midpoint of the target band reduces the economic cost of high inflation and will achieve lower interest rates in the future. Since early 2020, the committee has recommended additional and indirect means of lowering inflation that are within the reach of the public sector, including achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains. Such steps would strengthen monetary policy effectiveness and its transmission to the broader economy. The repo rate projection from the updated quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. This concludes the MPC statement, and as usual, we would open questions and identify yourself and the name of the media house that you represent. This will be a first. No questions.
Afternoon, Governor and Deputy Governors. I'm Tana Anders from Reuters. I have 2 questions to start off with.
Did you say Tanya?
Tana.
Tana?
Yes.
Okay.
The MPC has revised its GDP growth projections at each of its meetings and now settling on 0.4%. Which of the underlying assumptions have changed that has resulted in this upside revision? And then similarly, what is the MPC's medium-run projection for both these assumptions and growth? And then my second question, restrictive monetary policy's function is to tighten inflation, but can also slow growth. How much longer can you justify restrictive policy? And do you have an estimate on how many percentage points it will shave off growth this year? Thanks.
Another one? Okay, online?
Governor, I have just one question from Audrey at Business Report. Is it not time to reduce the spread between the repo and the banking lending rate?
My name is Tembi Lecele from Bloomberg News. Thank you, Governor. First question, have interest rates peaked, and when do you think South African borrowers could expect lower interest rates? And then after yesterday's surprising slowdown in inflation, do you expect that trend to continue, or do you expect that inflation will remain sticky, and if so, why? Thank you very much.
Okay, thank you very much. GDP revisions, what assumptions have changed? I think that the big changer had been that load shedding had been less intensive than we had actually seen. That's the first thing. But the other was that the starting point for our growth forecast was higher because of the better outcomes that we actually had seen. So that would have been the key drivers. In terms of the medium term, what assumptions? We make assumptions from one meeting to the next in response to changing data and risks. And the things that we make assumptions about are things we are really uncertain about. Whether it is load shedding, whether it is oil prices, or whether it's what the other central banks would do around the world, those things are constantly changing. And you cannot make medium-term assumptions. You have got to take them from meeting to meeting. Restrictive policy is known to cap inflation. That is exactly why we have a restrictive policy. We are an inflation-targeting central bank, and this is the tool that we have. And it's a tool that we would deploy in response to any inflation risks that on the horizon, and in response to the outlook that we foresee. It is known that it could cap growth. Yes, it does have an impact on growth, but it only has an impact on cyclical growth. What sometimes worries me is the discourse on growth that seems to think that you can change the long-term potential of this economy by playing around with monetary policy. Monetary policy only affects cyclical growth, meaning it affects growth over the next 3 to 6, 8 quarters at most, and beyond that, it doesn't do much. But has monetary policy really restricted growth here? Well, what is the potential growth rate of this economy? The potential growth rate of this economy is minuscule, negative 0.1 or so, and that even at this low rate of growth, the output gap is closed. The output gap is zero. And as we state, the output gap will tell us whether there are upward or downward pressures in the economy. And given that it is zero, we do not see upward or downward pressures in this economy, and we believe that given the risks to both growth and the inflation outlook, that our stance is an appropriate stance. Spread between banks and between the repo rate and banks, we do not set that spread. As you might know, some people borrow at prime plus something. Other people borrow at prime minus something. Others borrow at prime. So that there is that spread between prime and the repo rate. It's there. But how relevant is prime? I mean, if you are borrowing at prime, we could as well just say that the bank is pricing you at repo rate plus 350. And if you are borrowing 1% below prime, we can say that the bank is pricing you at the repo rate plus 250. So it's a never-ending conversation. That's I think as if everybody borrows at prime. There aren't that many people borrowing at prime, which is why it is called prime in the first place. You have got to be a prime customer. Thandi, have interest rate peaked? The answer is a resounding no. And as a good central banker, I will say to you, further than this, it depends on what happens to inflation. And so we have presented an inflation forecast. With this forecast, we expect that we would come back to the midpoint of the inflation target range in 2025. We continue to assess data and risk from meeting to meetings, and we will recalibrate policy based on those risks. Is this the end of the hiking cycle? No, it is not. It depends on the data and risks. That is what this boils down to. What is the inflation trajectory that we are seeing? We gave you a little sheet there. We expect that inflation this year will average 6%, that it would go to 5.3% in 2023 and decline further in 2025 to 4.5%. So that is the trajectory that we are actually working with at the moment. No, 2024 is actually 5%, not 5.3, 5%. Anybody on the line?
Yes, Governor. This question is from Spelele Zludla at Business Report. What were the reasons for the 2 MPC members who preferred a 25 basis point hike? Then Atol Dlamini had a question, but it's similar to Stembile's one, and you've just responded to it.
Okay. Any others?
Governor, thanks. Alistair Bull from Bloomberg. You've said that this isn't
Did you
necessary.
say Alistair Bull?
That's correct, yes.
Welcome back.
Nice to be here, sir. You've said you're not declaring an end to the hiking cycle, but so what could you tell us what your threshold would be to either raise rates further or to cut, and give us some sense of how long you think you have to stay tight? Thank you.
Monique, also from Bloomberg. Could you give us your Q2 growth forecast, please? Estimate.
Another 3 questions this side, please. The impact of South Africa's energy crisis and its role in driving up costs has been covered quite extensively. Has the MPC considered the emerging concern of water infrastructure and the impact that that will have on inflation? And then just secondly, given that the quarterly projection model has been adopted, how did it affect this meeting? And then lastly, given that there has been rigorous tightening of monetary policy, do you believe that the current monetary policy and fiscal policy mix is a sustainable combination for economic growth?
Okay. Chris, I'll give you the growth and quarterly projection model questions to deal with. Kuben, you will deal with what would it take to raise rates and what would it take to cut rates? I think I've answered this question 3 times before. Let's see whether you have the same answer. Spelele, the reasons for the other 2 members to raise rates, you are presuming that this one standing here couldn't have been either of the 2. You can guess the way you like, you will never get it right because these things change from meeting to meeting given data and the inflation outlook. The reasons for keeping rates the same and the reasons for increasing rates are all captured in this statement. So in this statement, you will find the reasons of everybody who argued in the MPC. So sounds like the same answer we have given before. You will get the same answer at the next meeting.
Thanks. So let me deal with the quarterly growth rate numbers first. So I don't want to just give you the Q2 number because there's been a fair bit of adjustment. So that's gone up from 0.1% to 0.4% on a quarter-on-quarter basis. The year-on-year number has gone up from 0.9% to 1.4% on a year-on-year basis for that particular quarter. We've also revised down slightly the third quarter. We've revised down slightly the fourth quarter. But because those first two quarters are better than expected, you get the annual adjustment up from 0.3 to 0.4. On the QPM model, I mean, look, it's not, you can't really compare the July forecast to the previous, what would have been the July forecast if we had used the other model or the old model. The model is substantially different. It has different components that provide more detail around the impact of fiscal variables on the outcome. There's a range of spillover measures, so the way in which exogenous price pressures feed into core inflation. There's a different kind of breakdown on wages, and there's also an additional set of variables that look at growth momentum. So in addition to the output gap, we look at growth, the change in growth momentum. So it really is, I wouldn't say it's chalk and cheese. This is a revised version of the previous model, but it's just not very straightforward to compare the two and say, oh, well, it's different because of these things. The new model provides a lot more underlying detail for how different kinds of variables impact on the final outcome. We've issued a paper so you can get into the detail of that. We've talked about it a bit in the last monetary policy review. Thanks.
Thank you, Chair. Let me make sort of 2 points before I answer the question on the thresholds. The first is that monetary policy works with a lag. We don't know precisely what that lag is, but we think it's somewhere between 12 and 24 months. In other words, an interest rate decision taken today affects the economy, affects the inflation outcome in about 12 to 24 months' time. It's not an instantaneous effect, but it's also not uniform. Sometimes it works a bit faster, sometimes it works a bit slower, depending on how the economy is going. We have what in our minds we call a glide path down to 4.5, right? Inflation peaked at 7.8 in South Africa. We've had this glide path down to 4.5. And when we thought that inflation was not meeting that glide path based on how much we've hiked more. At the moment, I guess what we're saying in this meeting is that we think inflation is on that glide path to 4.5. The second equation or the second factor that we would take is what's our assessment of risks of that? And we have said that there are upside risks to inflation. But in general, at the moment, given the cumulative hikes in interest rates, we think that inflation is on that glide path down to 4.5. Right? And so if we think it's going a bit too slowly, we will add more hikes. If we think it's going much faster and we might undershoot on the midpoint of the target, you could then begin to consider an alternative monetary stance. We didn't discuss cuts at this meeting. We didn't discuss when we're likely to cut or when we're likely to start cutting, because our objective today is to bring inflation down to 4.5 and to bring inflation down to 4.5 sustainably. We know that inflation expectations act with a lag. So while monetary policy acts with a lag, inflation expectations also react to a lag. When those are sustainably at 4.5, we can then begin to consider those kinds of things. So we think we're a very long way off from there. I think I've answered that, Chair.
Thank you. Tana, you had two other questions. One had to do with the water infrastructure. We didn't discuss anything about the water infrastructure. Water prices, though, form part of the administered price index. And so to the extent that we had highlighted what we had been raising meeting after meeting since 2020 about the need to moderate those administered prices, including water tariffs, by the way, which had been rising faster than the inflation target, says that if that was done, it would assist the effectiveness of monetary policy, because we would then be acting in sync to bring down inflation to a level that we consider to be consistent with price stability, which is, in our case, the midpoint of the inflation target range. You then asked the question about the interaction, settings of monetary and a fiscal policy. We set monetary policy on our own, and monetary policy has got a very clear anchor. We have been given an inflation target. We deploy our tools to achieve the inflation target. Fiscal policy has got a multiplicity of objectives. And so whereas monetary policy and the inflation target, the central bank is on its own, can do these things, deploy its tools to achieve the inflation target. Fiscal policy is a different ball game. There are lots of other players out there, and although it is the responsibility of the national treasury to set fiscal policy, they have got a lot other players that they will have to have on their side, and it is never an easy job for them. But they identify their own fiscal anchors and what they consider in setting fiscal policy. That is for them to decide. Put simply, they don't tell us what to do and how to do it, and we don't tell them what to do and how to do it. What we do have is that in executing our mandate, the Constitution tasks us to have regular consultations with the Minister of Finance. Underline that. Regular consultations with the Minister of Finance. That's all that we are doing. How have South Africa formalized this? We formalized this by the Minister of Finance and the South African Reserve Bank setting up in a memorandum of understanding a number of committees that assist the minister and the governor in their interactions. And those committees vary from the macro standing committee, and again there, every institution sets within its own mandate, and not only do they do that, they get to appreciate and understand the constraints that the other are facing. But even in that interaction, none of the institutions will tell the other what to do. You appreciate what we do. The second committee is a financial regulatory committee, which looks at regulatory issues in banking, insurance, and all of that, and they consider things and they advise the minister and the governor accordingly. The third committee is the Standing Committee on Banking and Financial Markets. That is where the interaction of fiscal and monetary policy rubber hits the road, because there is not just about debating what is an appropriate policy, what is not an appropriate policy, because the borrowing activities of the government impacts on financial conditions. And thus, because they impact on financial conditions, would have an effect on what the central bank then does and the posture that the central bank does. But that committee also plays an important role that you do not enter the market at the same time. So you would have seen when we had the sub-debentures, the auction date for the sub-debentures would be on a different day from the bond auction, will be on a different day from the treasury bill auction, so that there isn't a conflict of what each one of those are doing. And the last committee is an international relations committee, and that committee guides our engagements in multilateral fora in promoting South Africa's economic interests, whether we are in the G20, in the World Bank, in the IMF, in the African Development Bank, and so forth. That committee helps guide us. So that is how we have decided with the minister to set up how we interact between the two institutions and also give effect to the regular consultations. Besides that, the Minister of Finance can meet me, talk to me anytime that he so wishes, except during the blackout period, and I can talk to him as and when I so wish outside of the blackout period. So it's a continuous interaction. Some of these meetings do not even take place during office hours. Some of them take him during the weekend. I could call him and say, there is something urgent we must talk about. And he would say, okay, I'm on my way to your house. Or I'll say, I'm on your way to your house. And we would meet and talk and talk about that. It's a very dynamic interaction between the two institutions. Zianda? Last one from there.
Yes, last question from online, Governor, is from Fifi Peters, CNBC and MoneyWeb. Does the SARB believe it's been successful so far in the current fight against inflation?
The job is not done. The fight is still on. We are ready to deploy our tools to tackle this monster that is eating the income of South Africans. We believe that we had turned the corner. There are still risks on the horizon, and we are remaining vigilant to those risks. And should there be an indication that the risk could materialize, we would act appropriately. And as the Deputy Governor said, should we become more successful than we had initially thought, we might reconsider the policy stance that we have. But the job is not done yet. Thank you very much, ladies and gentlemen. That concludes our proceedings.